Okay, well, welcome everybody. My name is John Mazzara with Remax Results, and with me today is Tom Lewis of Thomas Lewis and Associates. He's actually my personal accountant, and he has been for, geez, I think over 20 some years. And so I have him today, and he's going to speak to us with regards to rental property and what it can do for you, the deductions, and he's going to share some stories as well. So, Tom, if a client was to go ahead and buy some rental property and they had never owned before, and they came in to see you, what would be some of the first things that you would talk to them about as far as how it might be reflected on their taxes, what they need to do, and that type of thing?
Yes, I would run them through the different expenses that they're gonna incur in rental properties and things that are deductible and how they're deductible, and those things that would not be deductible but rather depreciable, and how they figure the cost basis and how many years they can take their depreciation. And then we'd probably have to run through the benefits of real estate, the tax benefits as well as the economical benefits. We run through that a little bit, and probably what a lot of people are not aware of is the fact that sometimes the real estate is not fully, the losses are not fully deductible. Some people go into rental real estate thinking they're going to have these huge losses, and they don't. And when they don't, they're surprised because we have this thing called suspended losses, which can occur if your income's over certain levels. And so I'd make them aware of all of those things too.
Okay. And is there a difference in depreciation schedules for, let's say, rental property and commercial property and appliances?
Yes, there is. If you're into rental property that is residential, the basic building is over 27 and a half years after making some allowance for land. And so usually when you make allowance for land, you typically go to the assessor's value to see what they have as an allowance for land, because that's what the IRS does. Lacking that, you might want to take maybe 10% or 20% for land. And then if you have appliances or personal property of any kind, that typically is depreciable over a shorter period of time, like 7 years. In some cases in commercial, particularly in commercial real estate, by the way, which is depreciable over 39 years, the basic building and commercial, there, in some of the personal property there, you can write off right away under some new rules.
Okay, excellent. And you'd mentioned there's income limits. Does it matter if it's owned in a corporation, like let's say an LLC that I might own, or if I own it individually, does that change anything, or does it all flow through on my taxes regardless?
Not really. I mean, if you organize as an LLC, that's for tax purposes, that's considered in a disregarded entity, they call it. So an LLC does nothing for real estate, but it does offer a layer of security or protection in the event of lawsuits and that sort of thing.
Okay, so I'm going to be treated the same way. It's going to flow through my taxes either way.
It'll end up on your Schedule E, whether you're an LLC or not.
Okay. And
I know that lawyers push the LLC thing, but really it's just a legal protection is what it is.
Okay. And the Schedule E, that's my profit and loss, correct?
That's your profit and loss as part of your Form 1040, right?
Okay. And what if if I buy a fixer upper and I end up having to put a roof on the building and it costs me $15,000? Do I get to write that off that year on my Schedule E?
No, you would have to depreciate that over a period of time.
So that would
It's not part of the original building, so you could probably write it off over 15 years rather than 27 and a half. But some conservative accountants would probably make you do it over 27 and a half regardless.
Okay. So it's more or less part of my basis then going forward to a degree.
Yes. Yeah, large purchases like that are typically depreciable.
Okay. Is there any discretion, or what is it, like a dollar amount, or do we just discuss it as a client with you? And how do we figure out what is an expense and what might be an improvement?
Yeah, you would look at the size of the property you got. Like if you own a 170 unit apartment building, the materiality of what you might write off and capitalize is a little different than if you own a duplex down on Lindale or something like that. Then your materiality as to the size of expensing versus capitalization might be different.
Okay. And I know like back in 1986, they changed the Tax Reform Act of 1986 and they changed all the depreciation guidelines against ordinary income and things. Uh, with
It was
regards to,
horrible.
yeah, uh, with
Let me tell
regard,
you a story. Let me tell you a story. I
sure,
started out in 1970. I bought 2 duplexes off of Lake Street. I borrowed
sure.
$5,000 from my aunt, and I was gonna be a real estate Mongol someday. And so it started out really good. And I worked for a local CPA firm at the time. I learned quite a bit about real estate from these guys. And I bought more property, more property. I found out, which really attracted me to real estate, was that you could have real estate losses. You could accumulate these losses because in those days you could write off real estate over sometimes 50, as low as 15 years at one time. It was 15, 18, and sometimes it was 20. So they kept changing it around. And back in the 70s, I mean, if you were smart about investing in real estate, you could fix it so your real estate losses would offset all your other income and you would not pay any income taxes at all. And a lot of people did that for years and years. And then, as you just now mentioned, Congress came up with the Tax Act of 1986, and they ruined it all for us. But it was great up until then. It's still good though.
So if I was an investor today and I went out and bought a building, I couldn't depreciate and exceed maybe the income that the building is generating, or up to like $3,000, or is there a limit, or how does that work? If I have another job where I make all my income, but I have lots of losses from real estate, you'd mentioned something about suspension, or how does that
Yes,
work?
if you're not involved in real estate and your income is like say over 150,000, all your losses on real estate get suspended, which means you don't lose them. They just get shoved forward into the future. At some point, someday, when and if your building turns profitable, those losses will first offset the profit on those buildings or building. And if by the time you get to the point where you're going to sell it and you haven't used up all those suspended losses, you'll be able to use it against the gain on the sale of the building when you finally sell it.
Okay.
Now, if you're like John Mazzara and you're involved in real estate to some extent, or maybe it's all you do. We have a few clients where owning real estate is all they do. Then you're considered a real estate professional. As such, you can deduct all your losses all the time. For example, one of the reasons I suspect Donald Trump didn't want to release his tax returns is he's a real estate investor. Only his stuff is in the millions, and I'm sure he pays no taxes either. And he didn't want that to get out to the public, I'm pretty sure.
Sure. Okay. Well, good to know. So at some point, so it's really right now only applicable to people that are engaged in real estate full time that can utilize all the losses.
Yeah, there was a loophole there for a while, but I noticed they just closed it. Where if you have a husband and a wife, and let's say the husband goes to his daytime job, that's not real estate, and the wife is pretty much a stay-at-home mom. For a while there, we could classify her as the real estate professional,
Hmm,
if she had enough time at it. But then I think recently they came out with a new law that says that that doesn't work anymore. Basically, so many long words.
Interesting. All right. And then I know there's, if you buy a building and you hold it and and it hopefully appreciates like it's supposed to, and you depreciate it down and you have this big gain, and you eventually want to maybe redeploy that equity in another building and you sell it, but you're facing this huge tax loss, either, capital gains and things. How can somebody avoid that? Like through an
Well,
exchange?
there's this thing called a 1031 exchange, which I know you're well aware of, and many people are. It's called a tax-free exchange, as long as you exchange like for like property. So you can exchange out of let's say a low basis, low cost property into a more expensive, bigger one. And you can move that equity into this new property through a 1031 exchange. And a 1031 exchange involves 3 parties. You have a buyer, a seller, and then you have what's called a facilitator. The facilitator is the third party you need in a 1031 exchange, and he or she is a real estate professional too, and that's pretty much all they do is they facilitate these 1031 exchanges. So what happens in a 1031 exchange is exchange is that your gain doesn't go away. It simply gets deferred into the next property. For example, let's just say you had a property you paid $500,000 for, and you depreciated down to 300, and you got it for sale for 600, so you have a $300,000 gain, right? And then let's say you want to exchange that into a bigger property. Well, that $300,000 gain, let's say you exchange it into $1 million property. Well, that tax basis in the $1 million property gets reduced by that $300,000 gain you deferred out of the first property. So it doesn't go away. It just gets deferred forward into the next future property.
Okay. Am I ever able to move into a 1031 property and then maybe sell it and utilize my marital exclusion, the 250 or 500, if I'm single or married? Am I ever able to do something like that?
You can do something like that. Yes, you could move into your. You could go either way. You can either move into your rental, or you can move out of your personal residence and turn it into a rental. So you can do it either way. The key is that if you're gonna sell it and utilize the what do you call it, the exemption for personal residences, it's a $500,000 exemption on a married couple. It's $250,000 per person. So you have to have lived in that residence 2 of the last 5 years to use that exemption.
Okay, nice. So we could move into a rental property and then avoid at least some of that gain, as long as it's within those dollar amounts. If I live
Now,
there,
can I tell you a story?
please.
There was I had this client, they lived in Minnetonka, and they had this rather large house, and they decided that she was going to become a doctor. So they moved from Minnesota to this island in the Caribbean, and they rented out their house because they thought they were coming back. Well, then he got a big job offer in Honolulu, Hawaii. And so they moved to Honolulu, Hawaii, and they gave up on the doctoring thing, I guess, or deferred it. And so they moved to Honolulu, Hawaii, and they kept running their property, and they lived there for a while. And then he got another big job offer in Connecticut. So they moved from Honolulu, Hawaii to Connecticut. And so when they finally got to Connecticut, they decided they're probably not going to move back to Minnesota. And so they decided to sell this house they had turned into a rental property. And it turned out they had a pretty good offer. It had it a long time, but they had depreciated it down somewhat as a rental property. And so they had kind of a low tax basis. And they were wondering what the tax cost was going to be. And so we calculated, and it turned out it would be about $150,000. And so, well, they didn't like that. And they were wondering if there's something they can do about that, like all people do when they got a big gain they're faced with. They'll figure out a way to avoid it. So they had been in the rental property for a while, so they're kind of used to it. And I said, well, what about 1031ing into another real estate property? Well, they didn't really want to go into residential. And so I suggested a triple net lease property. Well, they said, well, what is that? And I said, well, you see these Walgreens or these CVS or Perkins or all these buildings around town, these freestanding buildings that these big national companies have. They are not owned by the big national companies. These big national companies are probably on the stock exchange, and they don't like real estate because in real estate you have to depreciate it, which suppresses their stock earnings. So they don't like it. So these buildings are sold as triple net lease properties to investors. By triple net lease, that means the renter of the property, the tenant, the big nationals, they pay all the expenses, and you, the owner of the property, you pay nothing. They take care of everything for you, and you just own the building. So by triple, they mean the tenant pays the interest. I mean, not the interest, the property taxes, repairs and maintenance, and insurance. So they pay all that on the building, and you, the owner, pay nothing. Well, they like that idea. And I mentioned to them that there's these Dollar General stores out there, which I suppose I shouldn't mention, but these are rather small buildings, which kind of fit the amount of cash they're getting out of this exchange. And so we worked it out. So they eventually bought a triple net lease property with Dollar General, out of Pennsylvania. And now instead of paying $150,000 tax, they got a $1.5 million building minus the gain for tax purposes. And they're getting a couple $1,000s a month rent out of it.
Maybe that.
So worked out pretty well for them, actually. And not only that, but this cash flow is partially tax sheltered by the depreciation on the building.
Wow. And that was an idea that you brought to the table that nobody else had thought of or told them or shared with them.
Most people have never heard of triple net lease properties. It's kind of something the big guys do only because it takes about 300,000 to get into one, even a small one. So you don't hear of them too often, but it's happening more and more nowadays with people, selling small rental properties for quite large amounts of dollars. In fact, I had a guy in St. Paul. He had, I think it was 4 duplexes or triplexes combination, and he was older and he wanted to kind of get out of them. He was tired of residential tenants. And he went into $2 general stores on a 1031. And his plan is to pass it off to his kids or kid or whatever it is he has eventually. And what'll happen, speaking of that, what'll happen is when he finally passes away, his properties get what's called a stepped up basis. That means the tax base becomes the fair market value of that property on the day of your death. So with that in mind, that is a way you can avoid completely forever the tax on some of these properties. It's a tough way to go to have to die, but you're going to do it. You're going to do that anyway. So you might as well get some for your heirs out of it.
No doubt, no doubt. Now, capital gains, Minnesota has a capital gain rate plus the federal, don't they? If you sell the building?
No, Minnesota has no capital gain.
Okay.
Minnesota tax rates at its highest is 9.85%.
So would I pay that in addition to a capital gain if I sold the building?
Yes. Yeah, you'd have the federal capital gain, which is 20% right now, and then you'd have the Minnesota, which is 9.85. So you're close to 30%.
Okay. Unless I do an exchange. Or if I have, let's say, a stock portfolio and I happen to have a dog, can I offset my gain with another type of a loss? If I have a real estate capital gain, can I offset it with a capital loss of another, like stock loss?
Yes, you could.
Okay. So I might do some tax loss harvesting of my portfolio if I'm going to in the same year.
You could do that too. Sure.
Okay.
Sure. Or you could buy other property. You could buy personal property to offset some of the gain too. But we're talking about real estate right now.
Sure. Now I've heard something about like a Section 179 depreciation. I don't know if that are expensive. If I'm a real estate investor, can I go buy a bunch of stuff and write it off? Like, because I'm in the real estate business, like, can I write off my truck? Can I write off, part of my home office? Or are there certain levels of involvement in the business?
Residential real estate, you can't do that, but in commercial, you can. Some aspects of commercial real estate is eligible for the Section 179.
Okay, but not if I'm owning a couple of duplexes or something like that.
Well, I tell you, there's a way around that. For example, if you got a lot of property, if you have a lot of property, a lot of different real estate, several properties, what you can do is you can set yourself up with a property management company as a Schedule C operation. You could charge management fees to your individual properties and funnel that income over into a Schedule C self-employed type of operation, I guess you could say. And with that Schedule C self-employed type operation, you could write off, your car, your truck, or whatever that way. So it's a way you're not in the real estate area. Then you're in another venture, or you could set up an S corporation or something to manage your properties.
Okay, but yeah, one kind of ties with the other. So I really couldn't. If I didn't have my rentals, I wouldn't set up the other business. Whoop, I think I lost your picture there, Tom. Can you hear me, Tom?
Yeah.
Okay. Our beach scene has gone away, so I don't have you on the beach scene anymore, but I have your volume. So maybe what we'll do, I mean, this has been excellent. Tom, can you tell everybody how they would reach you if they wanted to reach out? And I mean, you're very knowledgeable and you've shared a lot of secrets today that I don't think the average person would know. How can they get in touch with you and your firm? Would they?
I'm trying to fix the picture, but I guess I'm dumb at this stuff. It's Thomas Lewis and Associates. We're on 6800 France Avenue South in Edina, next to Southdale. And you can email me at tom@tlewiscpa.com, or you can call me at 763-313-9011.
Okay, and you obviously do lots of business planning in addition to regular taxes for people. Is there, I mean, you do small businesses, large businesses, individuals. Is there anything that you don't do as far as, your accounting work? Or
No, pretty much full service. We've been around since 1973, which is probably older than you.
mm-hmm.
But
Almost.
so
I was born in '64.
oh,
Almost.
sorry.
I still think
Yeah.
it's
So
I'm sorry, go ahead, Tom. Hello, Tom.
yeah. Hello.
Oh, okay. So full service, you do everything, and you have a number of offices too. If somebody, if you happen to be busy, there's other accountants that are working with you that they could see as well. I know you're the one I want to see, but I mean there are other people that are in your
Yes.
firm.
Yes, we have several others accountants, and we have offices in Shakopee as well as Mendota Heights.
Okay, fantastic. So you serve the whole metro area.
Yes.
And so anywhere in the metro area. What if they lived, let's say, a little bit outside of the metro? Do you do things remote where people can send in their taxes and you can communicate?
We do. We have a lot of people outside the metro. We're not geographically restricted to anything really. I mean, we have clients in California and Florida and Arizona and Texas and Connecticut. I mentioned people in Connecticut and New York. I mean,
Wow.
nowadays you can, with the networking and internet the way it is, you can operate from pretty much anywhere.
Perfect. And you're a CPA, of course, and you also have a master's in tax, don't you, Tom?
Yes, I do.
Okay. And then a couple of business certifications for valuing businesses and things, and I believe as well.
I did have that at one time, but I let it lapse. It just can only be good at so many things.
Okay. Sure. Well, you're very knowledgeable, Tom. I really appreciate you taking the time today. Everybody who is interested, Tom would be happy to speak with you and provide you direction. Like I said, my family, not only myself, but my family has been using Tom for a number of years, and he helped me with my businesses. So he's been my business accountant, my personal accountant, and my family's accountant. So I feel you'd be in good hands. I'll reach out to Tom if he can help. Thank you for watching today.
Hey,
Thank you,
John.
Tom.